You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello and welcome to Investor Way with me, Sam Ball. It's the 8th of October 2024 and I'm joined by my co-host John McEwen for the first time in almost a couple of months actually, so apologies for the gap. However, we've both been on holiday between us for about 5 out of the last 6 weeks or something like that. We recorded a chunk of interviews to fill the gap and we ran out of interviews, unfortunately, so we've had a little bit of a gap. But we're now back with our first regular episode for almost 2 months. So, John, do you want to start us off with a technical debut on the show?
Oh, well, it's a technical debut. So it's Barratt and Redrow. We have covered them separately before, and we did mention the acquisition or merger with Barratt approaching Redrow. I believe that is going to be confirmed or get full approval, I should say, in the next few days. It hasn't quite yet at the time of recording. But anyway, in terms of the full year results that were published, full year numbers were not great. Barratt's full year revenue fell 21.7% to £4.2 billion, as new home completions fell from 17,206 to 14,004. Underlying pre-tax profit more than halved to £385 million, and this reflected higher build cost inflation as well as lower completion volumes and average selling prices. Free cash flow fell from £0.4 billion to £0.1 billion, and at the year end, net cash stood at around £900 million, down from the £1.1 billion a year earlier. Barratt's order book fell from £2.4 to £2.2 billion, and Barratt's planning to deliver between 13 and 13,500 new homes this year against what they describe as a challenging market backdrop. The Redrow acquisition was completed in August and is expected to gain final approval, or as previously mentioned, from the regulator in mid-October. A final dividend of 11.8 pence a share was announced, and this takes the full year total to 16.2 pence, down from 33.7 pence in the prior year. And the shares were down around 1.5% in early trading. I think we've got used to seeing this sort of statement from some of the big house builders, obviously Redrow being no exception. It's been a very difficult couple of years with the high interest rate environment. I think, as I've previously said, despite this, there are shoots coming through. They are expecting the numbers to moderate a bit. And I think going forward with building on the agenda with the new government, hopefully with interest rates falling, this will stimulate the market. And there is a lot of demand in the UK for houses. We have structurally a shortage. And I think particularly with the Redrow acquisition, they are covering kind of all ends of the market. Redrow was generally a bit more in the south of England and also at the higher end. So I think with that, and potentially with the scale that they've now got as the biggest house builder, I think that will really help. From a valuation perspective, the market cap is now £6.6 billion, and valuation, it's depressed, has a forward price to book ratio of 0.92 compared with a 10-year average of 1.17, and that dividend is hovering around the 3.5% mark. So I'm happy holding it. Obviously, I don't have my Redrow shares anymore. I basically got, it was a paper deal, so I got the Barratt, or now what is Barratt Redrow shares, and I'm quite happy holding tight because I think over the next 2 years, the fortunes of Redrow and the house builders is likely to turn around. So I'm keeping those shares and hoping for the best. Sam, what are your thoughts on Barratt Redrow and these results?
Pretty similar. We covered both of them a lot prior to this deal. And I think in fairness, we've liked both of them as well. I think what's going on now is more of a reflection probably of the general housing climate rather than being company specific. There's nothing about this deal that makes me think it's not going to work. I do question whether there's going to be that much synergy between the two. I guess there's some departments where they won't need quite as many staff and stuff. But I'd have thought, given the scale both of them already have, and that I guess a lot of the costs are associated with, like, they'll do the outlets and stuff, and you're still going to have them for every site. I wouldn't expect loads and loads of synergies, but you never know, might be pleasantly surprised by it. Even with the land banks, I can't see it making a huge amount of difference because they're still sort of going after the same kind of land and stuff. So I don't think there's going to be loads of synergies. But that being said, I like both companies, and I don't think it's a terrible deal for anyone.
Fine. Is it a company that you'd buy?
Probably not. But that's more just because I'm not really as income focused. And although the margins are pretty decent, I don't know what they are specifically for Barratt and Redrow, but they're usually 16 to kind of 20%, depending on how good the house builder actually is. I think for an income play over the long term, I think you can do a lot worse, but not for me just because it's mainly income based.
Fine.
I'm assuming you're planning to hold.
Yes, I am. And so far, returns have been pretty good for me. So yeah, I'm planning to hold. Although it is something, they are shares that are very volatile, and even though I haven't been in the market for decades and decades, you do see the cycles, and the moves can be fairly dramatic. So it's certainly not one for the faint-hearted, I would say. On to something that's, well, definitely property related, but a bit more growth orientated. Rightmove.
Yes, so Rightmove have come out with their half-year results for the 6 months ending 30th of June. Revenue was up 7% to 192 million. Operating profit was up 2% to 131 million. Underlying operating profit was up 1% to 135.1 million. The interim dividend was up 3% to 3.7p a share. The basic earnings per share was up 2% to 12.4p, and the underlying basic earnings per share was up 2% to 12.8p. So they've said the revenue increase of 7% was due to both agents and new home developers renewing contracts, upgrading their packages, and investing in additional products. And they said that the operating profit and underlying operating profit include one-off acquisition costs of 600,000 relating to home views and the strategic long-term investment in Coadjute, as well as a one-off charge of 3 million in relation to the investment in Coadjute. Never heard of that. I still don't understand why they don't just buy spare room, but anyway. Coadjute is an open ecosystem of purpose-built solutions for the property market, and it's built to speed up property transactions. So they connect buyers, sellers, and property professionals with data, services, and each other. When you join Coadjute, you enter a virtual deal room packed with powerful features. Collect property information, track progress, share digital ID. So that's quite good, isn't it then? So it's like, for example, like if you're buying a house or selling a house and you're going to a letting agent or whoever else, even a solicitor, one thing that's going to hold it up is going to be anti-money laundering, know your client kind of checks. And if Rightmove is able to validate that and hold it through Coadjute and just release that to all parties, that stuff like that could speed it up. So that's not actually a terrible idea. I think that's quite a nice little add-on. But I think it is just going to be an add-on because they've only spent,
it's about 10 million, I think.
10 million. So that's tiny, isn't it? So
in fact, I think that's maybe between Lloyds Banking Group, Nationwide, NatWest, and Rightmove. So it may even be smaller than that.
Okay. So they don't own 100%. They just own part of it.
I don't think so.
Okay. But then that concerns me a bit because you wonder how much effort they're going to put into this thing. Whereas if they owned it, you think, well, it might only cost 10 million, but it could be worth a lot more than that to them because they've got all these people they can pump it out to that might actually be interested in it. But anyway, we'll see if that does anything. But we've highlighted 100 million of returns to shareholders through share buybacks and dividends in the first half of 2024 compared to 97.6 million a year ago. And 10.1 million shares, equivalent to 1.2% of outstanding share capital, was cancelled in the year to 30 June. Market share leadership position remains over 80%, and that's at 86%, which is flat compared to a year ago. So far on the market, it's not really made a dent, despite all the panic earlier in the year. Total of 8.3 billion minutes spent on the platform, up from 8.2 billion a year ago. Membership numbers are stable. Average revenue per advertiser is up 6%. And they've said in the summary and outlook, they continue to expect revenue growth for the full year of 7 to 9%, with membership growth up 2%. And in terms of the valuation, the business trades at a PE of just under 25. And for anyone who's not been following the last couple of months, they have been subject to a few takeover offers from Rupert Murdoch-backed REA. They have been abandoned. Rightmove didn't really want to engage in discussions, which as a shareholder I'm pretty happy with, because I don't think we're getting a huge premium. It was actually less than it had traded for in the last few years, and I'd much rather own Rightmove because I think it's a very, very difficult business to replace. And just a few quotes from this article in The Guardian. Yeah, so the Rupert Murdoch-backed real estate company has abandoned its attempt to take over Rightmove after its fourth offer was rejected. And Robert Thompson, the CEO of News Corp, said the group strongly supports the decision to withdraw. And one of the quotes is, "We applaud REA's financial discipline as it is foolhardy to overpay for an asset, even if it patently has positive potential. As for Rightmove, we wish them well in an increasingly competitive British market. Unfortunately, the board did not make the right move.
No.
We were disappointed with the limited engagement from Rightmove that impeded our ability to make a firm offer within the timetable available. They had nothing to lose by engaging with us." So I think they come across a little bit bitter about it and just weren't used to being told no, really, is the impression I get from that. But I'm very happy with the decision not to sell. I think at 25 times earnings, it's not cheap, but for a business with an 86% market share, net margins
76%.
I had that figure in my head roughly.
76%, 74%. Sorry.
Yeah, usually hovers around 75 net profit margin. Basically a monopoly. I wouldn't want to sell it for 25 times earnings. I don't think they were really at the price at which I'd have thought, oh, actually, I'd be quite interested in that. I think these results are excellent, and I think these results kind of demonstrate really why it is such an excellent business. The results haven't blown the lights out, but 7% revenue growth, they've not really had to do a huge amount, and that will continue because of the fact they're basically having a monopoly. If they can do these one-off acquisitions to add extra features and products and services that complement kind of what Rightmove is doing, potentially you've got growth there, but I'm quite happy with just core Rightmove brand. So, and I'm not too worried about on the market or anything else. What about you, John, as a fellow Rightmove shareholder?
Yeah, no, I am happy that they rejected it. I think it was interesting to see what was going to be offered and what they valued it at. But I think they went up. I think the final offer was about £7.80 a share. And I bought back in 2021. Can't remember exactly what I paid. But as you say, back in 2021, the shares were about that price anyway. There has been the concerns and people have been a bit more bearish on the stock since CoStar acquired on the market. And then I suppose the potential for that to grow and eat into Rightmove's market share. But no, I think the moat is actually pretty strong, and the brand, they do essentially have a monopoly. I don't see that going away. And I think it's a very high quality company. So the offer had to be significantly higher than was made for me personally to have been interested. And I'm glad the board handled it in the way that they did.
So I think based on that, we'd have both voted against had it gone to a shareholder vote, I think.
Yeah, with our handful of shares, yeah, we would have.
It could be the difference. You never know.
It could be. I do like to be engaged with shareholder participation. But anyway, fine. Shall we move on to another British growth stock?
Yes. Have Fevertree's fortune started to improve yet?
Well, so they had the half-year results out, and the revenue broadly flat at £172.9 million, ignoring currency impacts, and that fell short of what the market had been expecting. There was double-digit growth in the US and the rest of the world, but that was offset by declines in the UK and Europe, where unfavourable weather in the second quarter and the timing of shipments weighed in on the performance. Despite that, the group did gain market share across all regions. Underlying operating profit rose from about £600,000 to £12.2 million as shipping rates, energy costs, and wider inflationary pressures eased. Free cash flow improved from an outflow of £7.3 million to an inflow of £22.1 million, and net cash, including lease liabilities, was around £59.7 million as of the half-year mark. Markets are now expecting full-year revenue to grow by between 2 and 3%, down from the 8% growth management guided at the start of the year. An interim dividend of 5.85 a share was announced, which is up 2%, and the shares were down nearly 7% in early trading. It's difficult because when you look at the valuation, it's got a market cap relatively small on the AIM of £901 million, and forward priced earnings of just under 25, compared with a 10-year average of 45.3. So by historical standards, it is cheap. But I think it's when you have the sort of valuation that's associated with Fevertree, you probably do expect better numbers than this. And first half revenue being broadly flat is disappointing. That being said, I think the success it is having so far, particularly in the US, and considering that the US market is certainly not saturated like the UK market is, I think that is a big upside for Rightmove. And despite these results being a bit disappointing, at 24, well, just under 25 times earnings, it's not terribly expensive when you consider that potential. It's difficult. I do like Fevertree a lot. It's grown on me over the years. One of the issues that had really stopped me looking more seriously at it in the past had been that really top evaluation. But when you're seeing it come down to sort of mid-20s with the potential that it has, I think it is attractive. And it's definitely high up there now on my watch list. It's very difficult to know, as with any stock, but particularly where the bottom is. And I suppose if you see some of those quality traits in it with that potential, do you just pull the trigger? I don't know. It's certainly high up there for me, even though these results are a bit lackluster. Sam, what are your thoughts?
I'm trying to get a normalized PE. The problem is with the normalized PE, what you consider normal. If you were to look at the last 5 years' results, the best year is the final year pre-COVID. It had earnings per share of about 50p, which on the current share price of £7.70 would give you a normalized PE of 15, assuming you think it can get back to that. Now, that being said, since then, it's done, if you were to go with the adjusted, although there's very little difference actually between the basic and the adjusted, but you go from 50p, it then drops to 36, then 39, then 21, then 13. I actually think it can get back to where it was. I think those results are actually quite good in that compared to what we've seen previously. One of the things we've been saying the last few times is a lot of these extra costs they're having and the inflation on the cost side is going to ease up. For example, the glass costs and the bottling costs. And yes, the costs are still high, but that is now starting to happen. But the margins are now seem to be improving. They're not where they were a few years ago, but I think glass is a commodity. It will rise and fall. And I think in terms of Fevertree as a business compared to where it is 5 years ago, I actually think it's probably in a better position because it's further along with that US growth. The market itself might be shrinking maybe in Europe and the UK, but it's making market share gains, and that's all you can ask it to do. And really, if it's treading water for a couple of years whilst the US builds, if that's growing double digits, I think that has a potential to be a much bigger market than the UK anyway. I think it might already be bigger, actually. Sort of vaguely recall that from the last time we looked at it. But yeah, I think that's got the potential to be a huge market. So if you to actually go back and compare Fevertree now to Fevertree in those 2019 results, I think you could argue that now it's actually a better business. The only issue it's got now is that the costs are higher and that's out of its control, but a lot of those costs will just be cyclical. So I would actually back it. I don't know when, but at some point I would back it to get back to that 50p a share earnings. And I think if you're then getting it in a normal, I mean, even on the current P of 25, when it's got that double-digit growth in the US, it's making the market share gains. It's such a great brand. I think even at 25, it's pretty decent. But if you consider that P to be normalized of 15, I mean, how much cheaper do you think it's going to get, really?
Well,
it might drop another 30% and you might miss the bottom. But I think at these prices, you could still do very, very well. So I really like it in conclusion.
Would you be buying shares yourself?
I'd need to sell something to do it. If I had cash that was available to actually use for buying shares, I think I would. Actually, I think I'd have a nibble at this point.
Yeah, interesting.
Maybe once my pension's moved over.
Okay. Fine. Want to go in the pension?
Potentially, yeah, once I've got my SIP transferred. But yeah, so I'd seriously consider it actually at this point. I think so. Even last time, I think I liked it, and I think it was about 1,000, and it's dropped like another, or sorry, £10, but it's dropped like another 20%, I think, since we last covered it.
Yeah, no, I think it has.
And I liked it 20% ago. So the answer should be yes.
Fine.
Right.
Okay.
Shall we move on to Trustpilot? So, one that we've covered a couple of times before and both liked. Trustpilot, obviously the ratings website, have come out with their half-year results, and bookings were up 20% to 117.5 million. Revenue was up 18% to 99.8 million. Operating profit it swung from 2.1 million loss to 1.8 million of operating profit. If we use adjusted EBITDA instead, which I prefer not to, and there's operating profit there, but if we use that instead, that was up 86% to 10.6 million. Basic earnings per share was up 407% to 1.8p a share, I think. Operating cash flow was up 24%, which is probably the best measure of the business, actually, to 11.4 million, and adjusted free cash flow was down 6% to 5.9 million. They've highlighted that platform users continue to grow, with 67 million unique monthly users, up 28%, and now over 300 million reviews on the platform, demonstrating the network effects. They've got continued operating cash generation, with cash at the end of the period of 76 million, and that's down from 91 million a year ago after completing the launch of a 20 million pound buyback. And they've launched a further share buyback of up to £20 million today, given their strong cash position and confidence in future cash generation. Adrian Blair, the CEO, has said as part of his comments that consumer adoption of the platform continues to grow, with unique monthly users up 28% over the same period last year. For businesses, we released a series of new product features to our software platform in April, which provides unique insights into customer behavior and market dynamics. We are pleased with the early feedback we've received. In terms of the revenue split, 40 million out of 100. So about 40% of revenue is UK, 40% Europe and rest of the world, and about 20%, 21% US. The UK side was up 16% to 39.9 million. Europe and rest of the world was up 18% to 39 million. And North America was up 16% to 20.9 million. Annualized recurring revenue was up 18% to 211 million. Number of reviewed domains was up 19% to 1.171 billion. Number of claimed domains was up 23% to 933 million. And the number of active domains was up 14% to 121 million. And the average contract value per customer was up 18% to $8,221. The number of reviews was up 24% to 296 million. And in terms of the valuation, the business trades at a PE of 177, and price to free cash flow is about 80x. However, as we've seen in those results, obviously it's now just starting to swing to operating profit. It'll be the same story with the earnings. So at the minute, it's just not really a usable metric. The issue is I don't know what is. The market cap's 964 million, so I guess you could say that's pretty low. But I think this is a really interesting business. I was hoping it might have got cheaper since we last looked at it, but it seems to have actually moved in the other direction, unfortunately. But it's a business I'd really like at the right price. I just don't know what that price is. I think I'd rather wait until it's got some operating profit and some earnings, and it's actually got a sort of a PE that I can use and understand. Because to me, I'm just not paying 177 times earnings, especially with Trustpilot. Because although I like the business and I think it's a really interesting business model, I don't know how big that market could be, and I think it is actually quite a unique business, so there's not really anything to compare it to. So I think it's a really difficult one to value, and I think because of that, I'd probably rather just sort of sit on the sidelines for a year or two until I've got a better idea. What about you, John?
Yeah, I think a bit boring, but similar to you, and certainly at the current price, I think I'd be very wary and probably following it on the show for another couple of years, getting to know it a bit better, even if it is more expensive at that point, and then making a firmer decision, one way or the other with it. But probably a little bit early for me at the moment.
Right. Should we move on to our next business?
Yes, which is next. So next, it's a favourite on the show. We've covered it many times before. The group had their half-year results out, with half-year sales rising by 8% to £2.9 billion, with growth in online more than offsetting the 2.1% decline in retail. Full price sales were up 4.4% on last year, and pre-tax profits rose 7.1% to £452 million, helped by the uplift in revenue. Free cash flow fell from 436 million to 306 million pounds, due mostly to increase in stock levels. Net debt, including lease liabilities, remained broadly flat at £1.7 billion. After a strong start to the third quarter, sales and pre-tax profit guidance for the full year has been raised by £15 million to £995 million. And there were £125 million of share buybacks that were completed in the first half, an interim dividend of 75 pence a share, which is up 13.6% on the prior year. And the shares were up around 3% in early trading. I thought these results were really good. I know we've talked about Next and it continuing to deliver. I think it's particularly encouraging that it has been doing well in Europe, because you do feel that in the UK it's sort of approaching saturation point and that we can't be that far away. And then I guess the argument always is that we come to, where does it go from here? It's pretty big now. It's got a market cap of nearly £12 billion. And from a valuation point of view, it's trading at just under 16 times forward earnings, which is on the more expensive side that we've seen. So it's one that I do really like. It's on the watch list. I don't know whether it's top. Well, it isn't top of the watch list, but it's certainly a very high quality business and does put most of sort of bricks and mortar retail to shame. And it's really, I think, impressive how it's transitioned into the position that it's in with this hybrid model. And it's probably got the most successful example of that on the FTSE 100. Sam, what are your thoughts?
I agree. Fantastic business. I mean, it's at the point where I'm starting to look at these and I'm just kind of thinking, how have they done that again? There's no comparable retailer in the UK that is able to do what they're doing with their consistency. It's just a fantastic business. I think if they can go and do that in Europe, it's probably actually quite cheap. But I just think in Europe, does the Next brand actually mean anything to anyone? And I don't know if it does. I don't look at Europe and think, yeah, that's going to be a raging success. That's my issue with it. But management have done such a fantastic job with this business. You wouldn't bet against them. But yeah, I just don't know how they keep growing at the rate they are. Because I mean, it's not loads above them, but they're going a good few percent above inflation like clockwork. And I just don't know how they quite difficult climates. And there's not really, I can think of another retailer since we started the show that's been that consistent in terms of the quality of how much it's kind of beaten the general market by. But it's just absolutely fantastic business. Be interesting to see how they do in Europe and the Middle East as well. But I don't know if the same model will work there or not. I just don't know. So I think I think there's probably more risk than there was in the last few years because they are starting to approach UK saturation. But if they can crack Europe, it's probably actually fairly cheap. And even then, at 16 times earnings for such a high quality business in the UK, I don't think it's absolutely outrageous. And then they've also got the what is it, like the distribution software or whatever it is that they sort of they sell to other people too. So you've got the optionality from that. But yeah, it's just a fantastic business. But we'll probably be sat here in 6-12 months looking at 8, 9, 10% growth. But I kind of feel like with it, I sort of feel like we've missed the boat. I think the time to buy it was 2 or 3 years ago when we were raving about it and it was actually fairly cheap. But we didn't, unfortunately.
I know. We bought Boohoo instead. So.
Yeah.
Right. Okay. On to, well, is it the most expensive stock of the week, or maybe Trustpilot perhaps pips it? But Nvidia.
So Trustpilot will pip it on price to earnings. It will win comfortably on market cap, though. So Nvidia, I think it needs no introduction at this point. But we will make a point of saying that in our first fantasy portfolio episode, John did suggest it, and I declined. And I think if we just put like 1 or 2% in that would have driven quite a lot of performance actually, because I think it's sort of, what is it since then actually?
Oh, let's have a look. So this would have been,
I mean, that might have been enough on its own with like 2% in it to beat the market.
So that would have been December 2020, wouldn't it?
Yeah.
So if we'd gone in December 2020, I'm just having a quick look, it would be nearly it'd be a 9-bagger at least.
Yeah, so if that was up to 9% of the portfolio, that would probably might be enough to push us ahead of the FTSE world, actually, just on its own. But we didn't, so that's
we didn't. No.
So Nvidia have, well, these results they came out 29 August actually, but we've been away, so they're new to us. So they've come out with their second quarter revenue, which was up 122% to 30 billion. All divisions grew by at least double-digit rates, with data center the standout up 154% to 26.3 billion, benefiting from increased demand for Nvidia's AI chips. Underlying operating profit rose 156% to 19.9 billion, with a gross margin of 75.7%. The new Blackwell platform is expected to start generating several billion dollars of revenue in the fourth quarter. Blackwell, on the website, it says NVIDIA Blackwell architecture, the engine of the new industrial revolution. So it sounds impressive. Exploring groundbreaking advancements, the NVIDIA Blackwell architecture brings to generative AI and accelerating computing. Building upon generations of NVIDIA technologies, it defines the next chapter in generative AI with unparalleled performance, efficiency, and scale. So it's a new class of AI superchip packing 208 billion transistors, manufactured with a custom-built TSMC 4NP process, whatever that means. All Blackwell products feature two reticle limited dies connected by 10 terabytes per second, chip-to-chip interconnect in a unified single GPU. Oh, I want one. I don't know what it does, but I'm sold on it. And on the website as well, it's all like black and gold as well. It looks very good.
That's cool.
But if that's as good as it sounds, that will be very good. But yeah, so that's expected to start generating several billion dollars of revenue next quarter, which is actually quite a lot considering the revenue as a whole was 30 billion for this quarter. So if it was several billion, it'd be at least 10% straight away. Free cash flow rose from 6 billion to 13.5 billion, and net cash, including leases, stood at 25 billion at the end of the period. For the third quarter, revenue is expected to be around 32.5 billion, with an underlying gross margin of 75%. The board has approved an additional 50 billion share buyback with no expiration. The shares were down 3.1% in pre-market trading. So I think the issue is that even on a 50 billion buyback, which is a lot of money, you could buy back, if you were to do that with the biggest company in the FTSE, you could buy back about half the shares. But unfortunately, Nvidia has a market cap of just over 3 trillion. So it doesn't even make a dent, does it? It's just over 1%, like 1.25%, is it? In terms of valuation, it trades at a forward P of 37, 10-year average is 35, no dividend, and that compares to a prospective dividend yield for the last 10 years of 0.5%. I wonder if that's just because it's grown so much that the dividend yield's been pushed down to a point where it's basically zero. Yeah, fantastic results. Can't really knock it. I just think, would I pay 37 times forward earnings for a $3 trillion business? I probably wouldn't. I think the amount of growth to justify just that valuation, I just do not see how you get a market beating return. That being said, I wouldn't short it. What about you, John?
No, I mean pretty similar, but the same argument we was talking about when it was when it still had quite a big market cap, but obviously not 3 trillion. I mean, it's a remarkable business, and again, I'm much happier, I think, owning it as part of the all world index as a percentage there than I would be in terms of owning it just outright. Probably have a few sleepless nights with it, but what a job they're doing, and it's just incredible, mind-boggling the size of it. I think it's interesting also that over the last 5 years, you've sort of seen Intel continuing to decline with a market cap now of the group of under $100 billion. And again, ARM that we've talked about before, and that was something that Nvidia did try to buy. I think it was competition issues with it, but that's growing well. That's got a market cap now about $150 billion. And that was previously listed on the FTSE 100, and I think it's sold to SoftBank back in 2016 at about $24 billion. So that has grown massively over those years. Obviously not as quickly as Nvidia, but also done very well, and that's been obviously relisted on the Nasdaq. So good for them too. But no, remarkable company.
Do you think it's telling or not then that if Nvidia is now 30 times the size of Intel, how far behind Nvidia would Intel have to be then? That at 30, I mean, I don't know whether they'd get it past sort of like competition authorities, but if I was 30 times the size of Intel, I'd be thinking about buying it. And if they're not, that probably tells you what they think of their technology.
Yeah,
it's, it's like what they're spending on the buyback. They could, it's not
Speaking
far
of
off what they need to buy Intel.
No, I suspect it probably lies in competition issues, and it may be that the technology, is has been far superseded. But I suspect it's probably competition issues, and the same with ARM when they wanted that, because I think again it was a competition issue rather than clearly they could afford to buy it. So I suspect that's the issue there.
Okay, so of the 6 businesses then that we've covered this week, Barratt Redrow, we'll do them as one. Rightmove, Fevertree, Trustpilot, Next, and Nvidia. Which one do you like the most and which one do you like the least?
I mean, I think Nvidia is an incredible business. It's just valuation, etc., that would sort of put me off. So with my own money, and for a stock that I don't already own, because I do have Barratt Redrow and Rightmove already, probably be Fevertree. I'd probably take a punt on that, actually.
Oh.
What were
And
you
your least?
expecting me to say?
I don't know, actually. I don't know. Maybe Next.
Yeah, no, I think the valuation has come down to a point where that it possibly discounting that US potential that it has, and that's what excites me and essentially tips me over with Fevertree.
What about least favorite?
Okay, so least favorite. It's a difficult one actually, because I think they're all good companies. Maybe Trustpilot. I think perhaps just a little bit unproven yet, and one that I'd like to see a bit more of before making a firm decision on it.
So I think my favorite would also be Fevertree for the exact same reasons we've just outlined. I think my least favorite would probably have to be Nvidia, actually, just because although Trustpilot's really expensive, it's expensive on a small market cap and it's only just starting to produce cash and earnings and operating profit. So you can't really value it. Whereas I think with Nvidia, you can value it. And it's really expensive, whatever metric you use. And I just think to pay 37 times earnings, no matter how good the business is, when it's at $3 trillion, I don't see how you get a market beating return. Whereas I think with Trustpilot, you could potentially buy it and get a market beating return. The problem is I just don't know. Whereas with Nvidia, I'm much more confident you wouldn't.
No, fair enough. Fair enough. Okay. Well, thank you very much for listening. We will have an episode next week, and we'll see you then.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.